But the bottom line is the next 20 or 25 years is going to see a dramatic increase in power consumption from the richest of the rich to the poorest of the poor. And is also going to have to see a dramatic investment in developed countries like the United States in the grid. You have to get from the power from where it is to where it isn't. And you have to have the ability for the grid to be addressable. That's probably a $5 or $6 trillion bill in the US alone.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart. Letting you know we are very lucky today to talk with perhaps the greatest living natural resources investor alive today, Rick Rule. Rick, how you doing, my friend?
I'm doing very well, Adam. The better for being back on with you. Thank you for having me back.
You're very kind. We're going to talk about silver, and not just the silver tongue that you have there, my friend, but we're going to talk about silver and all sorts of commodity topics today. Rick, you and I, we hop on here every couple of months and talk. I think this is one of the more interesting times to be talking about commodities. There's so much going on in the world right now that is driving current and future commodity demand. I just was starting to put together a list here, but obviously we have, the whole AI boom, which is becoming really a top national priority, and that's going to need just a gargantuan amount of new electrical capacity, energy capacity here in the US, but also in all the countries that are competing with the US. So there's going to be massive demands for energy. We obviously have, sadly, the events going on in the Middle East as you and I speak, and that is impacting the price of oil. We've had breakouts in the precious metals, all three, but particularly recently in both platinum and silver. And through all this, we have supposedly these big trade deals being struck by the new administration with major countries around the world, and commodities are a core part of those trade deals. So it's almost like where to start. So look, I want to touch on as many of those as we can in the time we have today. But before I do, given its proximity in time, let me just give you 60 seconds to remind folks that your annual symposium, which is a phenomenal event, is coming up quite fast. And there's multiple ways in which they could potentially attend that if they're interested, right?
Thank you for that opportunity. The Natural Resources Investment Symposium, which covers natural resource and precious metals investing, will take place July 7 through 11, either live in Boca Raton or via live stream from the comfort and convenience of your own home. It's gone on for about 30 years, Adam. If you make something a little better every year for 30 years, at the end of the program, it becomes pretty good. And I think our conference is actually great. We start with a different kind of macro, not macro from a journalist, not macro from CNBC, but rather macro from players, in a biblical sense, from the belly of the beast. We have David Stockman coming on talking about the budget. He ran the Office of Management and Budget under Reagan, knows more about the U.S. budget than any person alive. Daniela DiMartino Booth will talk about the Fed, not as a journalist, but as a former Fed researcher. Nomi Prinz will talk about the corrupt nature of Wall Street. Guess what? She was a partner at Goldman Sachs. You get it. We talk about macro from people who lived the organizations that they're talking about. We move on from there to portfolio managers and analysts who have lived and breathed resources for 30 years through bull markets and bear markets. From there, our exhibitors, every single public company exhibitor at the conference is owned and accounts owned and managed by the conference sponsors. No guarantee, sadly, that because I own something, the price goes up, but there is a guarantee that at our conference, the exhibitors are content, not merely advertisements. We turn down more exhibitors than we accept. And finally, Adam, all of those factors allows me to say to your listeners this, which no one else does. If you attend my symposium, either live or live stream, first of all, you'll have access to the recordings for 12 months, and you'll need them. But second, if you don't think I delivered value, either attending live or live stream, I will refund 100% of your tuition. We've done that for 30 years. We've had to refund less than 1/10 of 1%. But no other conference on the planet that I know of offers complete satisfaction or money back guaranteed. Rural Natural Resources Investment Symposium, July 7 through 11, Boca Raton, or in the comfort and convenience of your own home via live stream.
All right. And folks, I just want to underscore what a great event this is. And there's no more convincing way for me to do that than to say I'm going to be there as well. I'm traveling out there as well to attend it. So if you do go live and in person, look forward to meeting you out there. Please grab me in the hallways. Rick, your team sent over a URL for the conference that was a little long for folks to kind of remember if I mentioned it virtually. So I created a simple redirect. So folks, if you want to learn more about the symposium, maybe even buy a ticket there in person or virtual, just go to thoughtfulmoney.com/rule symposium. I'll also have that link right below this video too. So if you just want to get there with one click, folks, you can. All right, Rick. Well, look, let's roll up our sleeves here. I mentioned a number of those big macro trends of what's going on in the commodity world right now. Hopefully I got the big ones, but if I missed out any other really big ones, please feel free to add them. Where do you want to start? Maybe because it's topical, just given what's going on in the world and the late breaking developments that are happening kind of hour by hour right now. Maybe we should start with oil. What are your thoughts right now, looking at this from an oil investor standpoint?
Conflicting. The weakness that we saw in the oil and gas price before the escalation of the conflict suggests that the global economy is slowing. Oil prices are set on a day-by-day basis. And when you had a period where oil production was plateauing and even declining a little bit, and the oil price was declining, that's oil markets trying to tell you that global economic slowdown is with us. All of a sudden, there was a geopolitical challenge to that. If the Iranians, in an attempt to protect themselves or whatever, fired a missile and hit a tanker in the Straits of Hormuz, you would very quickly see triple-digit oil. I'm not saying it's going to happen, but that has been a choke point for world oil supplies for 50 or 60 years, and that remains, in fact, the case. How is this going to end? Nobody knows. If the conflict ends quickly, I think you'll likely see a decline in the oil price because I think both oil and copper prices tell you that the market is seeing a dramatic slowdown in demand. I'm not saying we're in recession. I'm not smart enough to say that. All I'm trying to say is that the price of industrial commodities has been quite weak for three or 4 months.
Okay, so
I should say, looking long
yeah.
term, oil market's going to take care of itself. The oil industry is underinvesting in sustaining capital now to the tune of about $1.5 billion a day. If you don't make sustaining capital investments, you impede your ability to produce 2 or 3 years out. I would suggest that the surge in production in the United States is at or near its peak, depending on the oil price. At $60 oil, with today's interest costs, the low share prices of oil companies, which increases their equities cost of capital, we are running out of undrilled grade A locations from an economic point of view. So looking 2 or 3 years out, the surge in U.S. production that has driven world oil prices down, likely peaking, and the rest of the world, with a couple of exceptions, is not making sufficient sustaining capital investments to maintain current levels of production 2 or 3 years out. Many people don't think 2 or 3 years out, and I guess the fact that I do is what's allowed me to compete in these markets for years.
Okay, so let me make sure I'm following here. So we have a current surge in the price of oil that's related to the tensions in the Middle East. Who knows what's going to happen there? Obviously, if things get worse, they close the Strait of Hormuz, whatever, price could go higher here in the near term. If we cross our fingers, hopes that clearer heads prevail, there's a ceasefire, maybe even peace, eventually, whatever. You think oil price is going to reequilibrate, probably closest to where it was. Then over the next couple of years, you can see the oil price continuing to languish here for the reasons you mentioned. So, but at some point, you get to the point, like where you said, we've run out of the economic wells at $60, a barrel oil, and presumably we start to get some sort of supply tightness that I would guess would start to march prices up for some fairly long period of time until the price gets high enough that it can bring new production online, and all that stuff takes a while. Am I looking at the future with the same lens you are?
Absolutely. Yeah, absolutely. The ugly shortfall in sustaining capital expenditures, particularly in places like Mexico, Venezuela, Nigeria, suggests that the surplus production that the world enjoyed from those places 5 years ago is over. The Saudis are making noise about increasing their production, but they're not increasing their production. The only source of production increase that I can see on a global basis, 2 or 3 years out, would be Russia if peace broke out there. I'll leave it to your listener to decide how, what a realistic process that is. Absent that, I think you see higher prices 2 or 3 years out. Adam, I also think that you need to look at the continued deterioration in the purchasing power of the US dollar. And it might be that oil prices stay constant in real terms, but rise in nominal terms as the purchasing power of the US dollar declines. A lot of
Mm-hmm.
the increase that you saw in the oil price in the decade of the 70s had to do with the fact that, in absolute senses, the purchasing power of the US dollar in the period 1970 to 1980 declined, according to the Congressional Budget Office, by 75%. Uh, that itself was responsible for a fourfold increase in the nominal price of oil.
Okay. All right. So yes, we got to look at purchasing power depreciation in this mix as well. We'll talk about that a little bit more deeply when we get to the precious metals, because I'm curious to get a sense for you how much of what's going on there is being driven by that versus by demand trends. Um, but let me ask you this with oil. So at least here in the States, we have a new administration that's got elected on drill baby drill. Um, how does that work in an environment like you're talking about here, where it's just not that economic to drill if prices get back down to where they were, before things erupted last week in the Middle East? Can we really spur material incremental production, or is it kind of pushing on a string until oil prices start coming back up sustainably?
This administration has done one thing that's very useful to the oil industry. They've rescinded some of the executive orders of the Biden administration. And they have also let the regulatory administrations know that the logjam that existed in the Biden administration is over. That's actually happened. This isn't something that's in the mail. The regulatory climate around nuclear power, around gas gathering, transmission, LNG, all of that has changed rather markedly. And some of the executive decrees that were put in place during the Biden administration, which had a deleterious impact on the industry's ability to drill, have been rescinded. There is nothing that the president can do, I think, to overcome the basic economics of a higher cost of capital, unless he moves to direct subsidy, which I hope he doesn't do, and lower prices. If there has been the beginnings of turmoil in the non-investment grade credit market, the project finance market. Credit spreads have widened, and so for independent oil producers in the U.S., that part of the value creation cycle that's below Exxon or Chevron, costs of capital for project finance are up 200 or 250 basis points. At the same time that pre the Iran conflict, the price of oil has declined. Meanwhile, we've ridden a tremendous crest of technology, three-dimensional seismic measurement while drilling, hydraulic
Hmm.
fracturing. It would appear that at $60 oil, our inventory of grade A undrilled locations has fallen fairly markedly. You can skate locations back into grade A if you raise the oil price or you lower the cost of capital. But uh, or if there's a further conjunction of technology, in other words, if technology improves one or two more times, in the absence of technological breakthroughs, in the absence of lower real interest rates, or in the absence of higher oil prices, it would appear that the benefits that our country has enjoyed in the last 15 years from increased production, increased domestic production, it would appear that that's crested.
Okay, so you're talking about the shale miracle there. If we follow the trajectory that you think we will over the next couple of years, um, it may have crested, Do you expect it to kind of plateau and flatline, come off a little, or are you looking at some sort of precipitous decline here?
The rig count has declined a lot, which is to say that the economic incentives are not in place. This new oil price, $75 oil price, is a lot more benevolent than a $60 oil price. So if the industry believes that the prices are going higher in the near term, we can turn around that production decline in fairly short order. Uh, Watching the rig count will tell you all about the production that we're going to see in 9 months or 12 months. These wells decline precipitously. They
Right.
probably produce 65, 70% of their net present value in the first 18 to 24 months. So if the rig count continues soft, you're going to see U.S. domestic production fall fairly dramatically.
Okay. And that's obviously if the cost sort of languishes in the 60s.
Right.
You also mentioned one of the other levers that could play a role here is cost of capital. We have the US 10-year, which is a benchmark for lots of lending, uh, more elevated than the administration would like. We'll put it that way. Um,
That
at,
was funny, Adam.
at, at what 10-year rate, if it were to start lowering, would it make a material difference to the oil industry to say, hey, we can do more with this lower cost of capital?
That will depend on whether the spread between investment grade and non-investment grade credit rates continues to widen. What you've seen in the commercial banking market and, frankly, in the junk debt public market has been a broadening of credit spreads. There's beginning to be in credit a flight to quality. So while the credit spread from investment grade to non-investment grade 2 years ago may have been 200 basis points, it's more like 350 or 400 basis points now. So it isn't all the US 10. It's the relationship between the US 10 and the market for non-investment grade credit.
Hmm. And just this is my ignorance. For wells that are owned by the oil majors, right? I mean,
Yep.
these are massive companies.
Yep.
Are they non-investment grade credit or are they investment grade credit?
Oh, they are definitely investment grade credit.
Yeah.
Yeah.
Okay.
The Exxons, the Chevrons, those guys definitely definitely investment credit. They are this sort of cost of capital challenge that I described does not extend to the investment grade credits.
Okay. Okay. All right. Well, look, okay. So, we'll kind of wait and see on what happens with oil, but your default assumption here is anybody's guess in the immediate term with Israel and Iran and whatnot, but we'll all just hope that that kind of gets settled peacefully as soon as possible. That'll probably bring oil back down to where it was. Kind of a rough couple of years ahead of us, looks like. Production wise, we're going to start to then set ourselves up for a secular increase in the price of oil that will be probably not very welcome to American consumers. But it should start helping out the oil producers because more and more of these fields start becoming economic. And then hopefully, I think you would think this is hopefully, the deregulation, the drill baby drill policies and stuff that the administration is putting in place will help us recover from that shortfall faster. It's going to take a while, but we'll recover faster than we would have if the policies from previous administrations had remained in place.
I think that's accurate. I think oil and gas company investors need to bear in mind that oil and gas company equities on a enterprise value to net present value basis are cheap. Everything I've talked about is already discounted in the oil price, and I suspect that an investor with a 2 or 3 year time frame, or better yet, a 5 year time frame, that investor might not be happy owning Exxon at the end of 2025. But I suspect that investor would be thrilled owning Exxon by 2030 if he or she purchased it at today's prices.
Okay, thank you. Like a great interview guest, you intuited exactly what my next question was going to be. So excellent. So it sounds like industry is attractive from a midterm standpoint, but you're going to probably sit on some dead money for a while if you buy now. Okay, so just expanding to the entire energy sphere here, I mentioned in the intro about AI, and at least if you read the papers, This is one of the biggest, if not, the biggest national priority going forward in terms of trying to maintain America's supremacy, or at least as major world powers are going to compete for supremacy. And that is all largely predicated, that winning that race will be predicated on access to plentiful, cheap electrons. You look at the electrical power capacity that's been uh, rolled out in China over the past couple of years, it dwarfs now, Rick, what's capable in America. And America, is larger than all the other major countries around the world. So China's got a big head start in this, on this. Presumably, America is going to be ramping up to try to catch up as soon as possible. Talk about where you see the biggest opportunity in there. We hear stories of natural gas, sorry, being the bridge fuel until perhaps maybe nuclear comes on and really starts playing a much bigger role there. Where do you see the opportunity?
Everywhere. The truth is that the U.S. has been investing insufficiently in generating capacity for a long time. That is being brought to a head both by the retirement of coal-fired plants, which have had important market share in the U.S., but also, as you suggest, in the demand for all things electricity, including now data centers. It's important to look at this not just from an America-centric point of view, though, Adam. There's a billion people on Earth with no access to primary electricity. I suspect we'll address that over 20 years, the same way that the Chinese have addressed it over the last 30 years. And so it isn't just about using AI to run your smartphone better. It's about a housewife in Malawi that has no access to electricity, the generating capacity to run her home, the copper it requires to get that electricity to her home, and then all the stuff in the home. The difficulty right now with that lady in Malawi is that she can't afford to pay very much for it. And you and I can.
Hmm.
So the intermediate growth, I think that you're going to see, the funded intermediate growth that you're going to see is largely going to come in nuclear capacity. It is baseload power that doesn't generate carbon that goes 24/7. Some of the nuclear detractors say, well, we don't need nuclear for carbon free energy. We could use wind or solar or stuff like that. Uh, I think I said on an interview with you a year ago, Adam, the world needs more of all kinds of power,
Hmm.
including wind or solar. But it's worthy to note that we have over 40 years invested $5 trillion in alternative energy, and we've reduced the market share of hydrocarbons from a high of 82%, I think, all the way down to 81%.
Yeah, yeah, yeah.
Um, the truth is that demand for all forms of electricity are growing, but the demands for very high quality, uninterruptible, 24/7 power, and society's preference to do that without burning coal suggests to me that nuclear is where we're going to go. I sat in on the last quarterly conference call of Cameco, the second largest uranium producer in the world and the largest nuclear engineering firm. And they rolled out a plan to build 10 reactors in the United States, a $75 billion job if they're efficient. And they described themselves as highly confident that they could pre sell enough power on long term power contracts to the Amazons and the Googles and the Microsofts of the world that they could fund a $75 billion build. Um, I, I haven't lived through an epoch like this in the uranium business. I've been in the uranium business since the 70s. This is truly a sea change. But make no mistake, we're gonna need everything. The existing wind and solar fleet that we have a lot of capacity. There's a lot of stuff built out, but it's intermittent. And to make it work, Adam, to make sure that when you flip the switch at night when the sun doesn't shine, that you get electricity is going to require, as you suggest, natural gas peaking. It's going to require peaking capacity. But the bottom line is the next 20 or 25 years is going to see a dramatic increase in power consumption from the richest of the rich to the poorest of the poor. and is also going to have to see a dramatic investment in developed countries like the United States in the grid. You have to get from the power from where it is to where it isn't, and you have to have the ability for the grid to be addressable. That's probably a $5 or $6 trillion bill in the U.S. alone.
So, from your perspective, Rick, as someone who's been in the industry since the early 70s, um, how would you rate this boom you see coming in terms of build out and demand uh, for energy and energy related commodities versus other booms you've seen in your career? You know, is this the mother of all booms? Is it run of the mill? I mean, it didn't sound like a run of the mill one, but
Um, one of the things that you need to know about uranium, well, commodity markets generally, is that the cure for high prices is always high prices. If we spike this stuff, we will find some more uranium. Uh, the spot price that we have now, and spot's becoming increasingly irrelevant, but the spot price we have now, $75, is probably what's required as an incentive price. But that assumes that the purchasing power of the US dollar doesn't deteriorate, which I happen
right.
to believe is a bad assumption. Um, what has changed is the structure of the uranium market. First of all, oddly, it's politically correct now, Adam. 8 years ago, the Biden administration would have characterized me as a profiteer on Hiroshima, Nagasaki, and Three Mile Island. More recently, in the Inflation Reduction Act, what a dumb title that was,
Mhm.
they decided to subsidize me. To be honest with you, I felt cleaner when I was vilified than when I was subsidized. But personal feelings aside, it talks about the sea change in politics around uranium. It isn't merely permissible now, it's politically correct. I never thought I'd live to see it. At the same time, that we're developing a term market for electricity. The AI users are going to the utilities and say, we will agree to take or pay contracts, inflation adjusted with accelerators to take certain amounts of power against A-rated investment grade credits for 20 or 30 years. We've never had this in the power business. And beyond that, in the uranium business now, we have term contracts. There's no other commodity in the world that's free from the tyranny of the spot market. You know, if you and I drill an oil well, Adam, we have no idea what we're going to sell our oil for 3 years from now. If we build a
Right.
copper mine, we have no idea what we're going to sell our copper for 4 years from now. In the uranium business, you can sell a 20-year agreement with an investment grade counterparty, a Duke Power, a Southern Company, a Tokyo Electric Power, specifying price, terms, and escalators so that you know what volume you can sell at what price for 20 years.
Right. It's much
This
more like a
is
bond that way, right? I mean, it's
in effect, it is a bond. You can go to Westinghouse and they will build you a turnkey uranium mill uh, for a fixed price. At the same time, you can go to offtake partners and pre-sell the offtake to an investment grade counterparty, and you can literally take those two contracts to the bank.
all right. So, I mean, I could make this whole rest of this discussion with you just about nuclear, but let me ask my question one more time, but at a slightly higher level. When I hear you talk about the decadal demand slash race, maybe we call it the electron race, right? Here in America, but again, we're doing that to outcompete other countries, so they're doing the same thing, right? It's hard not to interpret that as just a multi-decadal um, surge in demand for commodities of all stripes, right? Because yeah, we need uranium, but we're going to need more gas. We're going to need the rare earths to build our windmills. We're going to need the solar panel inputs. We're going to need the copper for the lines. I mean, it just seems like a global bonanza for commodities. Am I looking at this with two rose-colored glasses, or do you feel similarly?
Maybe in the near term, too rose colored. Adam, there's no doubt over 5 years we're going to have production shortfalls in a lot of commodities because we haven't invested in productive capacity around commodities for 30 years, and you don't undo that right away. But if we have a serious recession, particularly a global recession, You can have demand falter a little bit. You can have supply falter if demand falters and you don't get an increase in price. So I think the timeliness of your forecast has to do with whether or not the world or the world's mouth, the United States, enters into a recession. There is zero doubt in 5 or 6 years across a whole range of commodities that we're going to have production shortfalls. The price impact will really have to do with the state of the economy. Looking longer term, what you say is absolutely inevitable. We are still enjoying slow global population growth. We are enjoying in frontier markets rather rapid increases in disposable income at the bottom of the demographic pyramid, the poorest of the poor. We have succeeded, by the way, as a species over the last 40 years in lifting 2 billion people from dire poverty to merely being very poor, which is a wonderful, wonderful thing, led by the Chinese. And my suspicion and my hope is in the next 20 years, we finish the job. We lift that bottom billion up to the point where they are merely poor as opposed to desperately poor. And when people at the bottom of the demographic pyramid get more disposable income, the goods that generate the most utility for them are physical goods,
Hmm.
material goods. Adam, if you get more money, I mean, yeah, you may buy another couple 50-pound plates to torture yourself in the garage, but mostly what you do is you buy a little gizmo, maybe at our age, a hearing aid or something like that. But when the poorest of the poor get more money, they replace a thatch roof with a steel roof. They replace mud wattle walls with cinder block.
Right.
They go from barefoot to tennis shoes to bicycle to 50cc motorcycle to Toyota Hilux. That is really commodity intensive. I travel the world looking at natural resource projects, and I always keep my eyes open to see how the rural poor are living compared to how they lived when I first started visiting these places. And the increase in material living standards that we're seeing globally is really, really heartening and also really good for natural resource based businesses.
So, and that's what makes it fun to be a natural resource investor because you can feel like you're playing, a role in that mission
Sure.
of good to try to elevate the
Yep.
rest of the world. So Rick, I've heard you talk about that before, and like you had me at hello, right? Like, I mean, that was one of my on-ramps to being a commodity investor, right? Which is, hey, we're going to continue to lift
Right.
the world up the prosperity spectrum, and that's going to just place more and more demands on commodities. But now it sounds like on top of that, we have this electron race, I guess is what I'll call it,
Correct.
which it just, like I would have been excited before you and I were talking about AI 2 years ago about
Yep.
that mission. Now we bolted on top of it, I think, just a massive amount of more demand going forward. And so, to me, it really makes me excited that you're sort of nodding as I'm saying all this. But to your point about I'm glad you brought it up because we have to be realistic, right? This is going to unfold over the next couple of decades. It's not going to unfold tomorrow. There will be peaks and valleys along the way there. And for the reasons you've mentioned to us, we may see lower prices in the short term anyways because of the structural issues that you talked about in terms of, how the economy is currently set up. If we do go into recession, say in the next year or two, for somebody with a long-term outlook, I would think you would think that that is going to be a gift. It's going to give you an opportunity to buy the winners who are going to really benefit from this coming couple of decades at really good values. Do you think of it that way?
That's exactly the way I think of it. It's exactly the way I think of it. Adam, I've graded tens of thousands of portfolios for free in my lifetime. And that's allowed me to see the things that most investors get right and the things that most investors get wrong. And further to your comment, the thing that most investors get wrong that's most correctable is that many natural resource investors have good strategy in the sense that they think that there's inexorable demand pull for commodities. But that's a 5 year thesis. And those same people tend to have trauma holding stock over a long weekend. So if you have a long term strategy and short term tactics, the most likely result is that you lose money.
Hmm.
There's no need for this. when people think that their time preference matters. I used to believe that my time preference mattered when I was a young man. I had that beaten out of me. Yes, you want gratification in 3 months so that you get the psychological satisfaction of having been right in an investment. But the truth is, that's not the way the world works. Uh, Most of us are going to be alive 5 years from now, 10 years from now, 20 years from now. And with the challenges that we have in other parts of the economy, like the deteriorating purchasing power of the US dollar, as an example, if you're an American, believe me, doing very well on a stock like Exxon over 5 years, I think is going to come in real handy.
Mhm. So, I also think too, Rick, like you've got a few years on me, but neither of us are the young men we were when we started out. I think increasingly about legacy here, right? Like assets that I can invest in today that I'm not looking to sell in a year or even 5 years, that I'm basically putting aside for the coming generations, right? And this to me feels like one of those great trends, right? Where there are entry points we may have over the next couple of years that if then kind of left alone for 5, 10 years, our grandchildren, maybe even great grandchildren might be like, geez, I'm really glad that my ancestor there had that foresight.
You need to teach your ancestors. There will be a point in time when these assets are overvalued.
Hmm.
I think of the decade of the 1970s. The oil price increased from what, $2.50 to 30. The natural gas, decontrolled natural gas from 15 cents to $15. Not a typo. The gold price from $35 to $850. The cure for high prices is high prices.
Yep.
And when every single influencer on social media has stopped talking about technology or AI or whatever it is that they're talking about, and they're all talking about resources, you will have had to have schooled your children that the cure for high prices is high prices. They will have to sell. The decade of the 1970s was my first boom, and I forgot to sell. I confused that bull market with brains. The consequence of that is at the end of the decade of the 1970s, I was a very wealthy and hubris ridden young man. And by 1982, the commodity price collapse, I had a net worth south of zero. By the way, most of the hubris then was scraped off.
No.
So, what you say is true, provided that part of your legacy is teaching the next generation that in resources, they're going to be a contrarian or they're going to be a victim. That the cure for high prices is high prices. And if you have a decade where resources scream, there will be a reckoning at the end.
Well, I love that. Be a contrarian or be a victim. Oh, absolutely. And I will be, there in the account. My notes in the account that they'll inherit will be keep going to the Rule Symposium. And even if you're not around, Rick, I hope the symposium lives a glorious long life, even in the years after you've shuffled off this mortal coil.
For the record, Adam, I'm a very healthy and engaged 72-year-old. To quote Warren Buffett, if longevity is partly a function of enjoying your life, I'll give Methuselah a run for his money.
Well, I hope you do, my friend. All right. Well, look, I want to get to precious metals before we wrap up here. Real quick, let me just ask you a quick sort of lightning round on
Sure.
energy. Um, so there's all sorts of developments that are going on in nuclear right now. One of which is just the small modular reactors, right? Which is, I want to focus on the modular part of it. I mean, pretty
Yep.
much every, as I understand it, every nuclear reactor that we built so far in the States, at least, has been a one-off, right? We've started from scratch, design-wise, process-wise every time. The
It is.
benefits of modular deployment is like the factory approach. Hey, we can just optimize, we can get costs down, we can standardize. A part breaks, great. We got 10 of them in storage. We can just bring it right out. Um, how important is the modular part of it? Well, let's start there.
I was at a conference about 3 years ago expressing some skepticism over demand for SMRs, talking about the technology. And the guy on the panel with me said, Rick, have you ever heard of the US Navy? We've been deploying SMRs for a very long time.
Exactly, in submarines,
All
yeah.
we need to do is adapt the present technology and synchronize permitting. And we can roll out SMRs like crazy. And by the way, Westinghouse, now an affiliate of Cameco, proposes to do just that. That will be, that will require a continuation of the political winds blowing in uranium's favor
Hmm.
and will require continued federal support. But we don't need federal subsidies. We need the administration or administrations to approve reactor designs, reactor types that are consistent. We need to be able to deploy 100 SMRs. We need to allow Westinghouse and Cameco to build 10 identical um, full scale traditional reactors. Uh, the problem, well, one of the problems with regards to reactors in this country, as you suggest, is that they've all been one offs. The Chinese build them sequentially with the same design. And the consequence is that what costs the Chinese $6 or $7 billion to build costs us 25.
Right, right.
Uh,
And 20 years.
yeah,
Yeah.
we need to address that.
Okay.
Uh,
So the standardization is a big deal on the kind of the game changer factor.
it's huge. We have better nuclear technology right now than the Chinese do, and they can bring in a reactor, including time value of money, at a quarter of the cost.
Yeah. Yeah.
We need to address that,
Okay.
and not
All
just
right.
from a competitive point of view. We need the power.
Exactly. Okay. And then from a technology standpoint, you understand this much better than I, but there are, I mean, we've had this technology for decades. We haven't built many new plants in the past recent decades. So we have the opportunity here to kind of upgrade the technology as we start to deploy new reactors. And there's all sorts of new different types of technologies. There's molten salt reactors. There's, a lot of chatter out there about thorium. It's been forever in coming, but that would be a different fuel that would, have some benefits and maybe even, some potential you don't really have the meltdown fear, I think, with a nuclear salt reactor, but certainly not with the thorium-based one. So my point is we know that the standardization is a big deal. This potential for new technologies and or new fuels, how big of a deal is that?
The last time that we had a intelligent permitting requirement in the United States was pre Three Mile Island. There were probably 1,000 satellite telephones, which are these big bricks that
Yeah.
people used to have. So think about the advancement that we've enjoyed in telephone technologies since Three Mile Island. We haven't deployed technology in reactor design, a lot of technology, for 30 years. What happens if the new reactor market becomes a $250 billion market is precisely the type of technological advantage that you've talked about. Westinghouse, mostly when the Japanese had it as Hitachi, continued to invest in nuclear technology when the US didn't. Mercifully, Canada, with US support, bought Westinghouse back from Hitachi. And so all of those Japanese and American and Canadian technological advances are back in North American hands. This is, I would suspect, the best nuclear technology in the world, including the Chinese technology, including the Russian technology. But the truth is, the Chinese are great competitors. I know the people at China General Nuclear, some of them quite well. It'll be a race between us and them that will benefit all of humankind. They will
Hmm.
be looking to sell their reactor designs around the world. We'll be looking to sell our reactor designs around the world. Um, Assuming that, and this is a big if, assuming that we don't have some human error in an existing plant, and we replicate Three Mile Island or Fukushima, uh, the future looks very, very bright for most aspects of the nuclear power industry.
Okay, great. I find this so fascinating. I could keep talking about it. I got to stop myself. Last kind of just crazy question, then we'll get to the precious metals. I've heard of this idea for a long time, or variants of this idea for a long time. I've seen some headlines about it recently, so I was excited to ask you about it when I knew you were coming on this week. Um, the best fusion reactor, in existence is the sun, right? And we're doing our best to collect photons from it from with our solar panels, but it's very diffuse, right? And so if we could kind of get closer to the sun, we could harness that energy much more directly. And there's talk about putting some sort of solar collector up in orbit and then taking the energy that's collected there and beaming it down to the planet in microwaves and kind of having this continuous, always on supply from the sun. Is that just science fiction and we shouldn't even think about it? Or is there anything surprisingly practical in the near to midterm about that?
I think, I mean, the best answer is this: I don't know.
Yeah.
Uh, that's the best answer. If I allow myself to speculate, my hope is that within 20 years, we develop a fusion reactor on Earth. The capital expense and the technological advance that would be required to launch an orbiting solar collector. Can you imagine the energy that we would spend just getting it there? Uh,
It would be a lot. I mean, thanks to companies like SpaceX, less than it would have been 10 years ago. But
yeah,
yes, it's a ton. Like I said, I mean, this could be
yeah,
complete sci-fi. And I don't know
yeah,
what the energy density of microwaves that would beam down from it, but it sounds like, hey, if it's something we could actually do, then just
yeah.
mainline tapping into the sun. Yeah, right.
I think that would be great. As I
Yeah.
say, I
Do we melt the
suspect
country that's receiving this? I don't know.
I wouldn't want to get in the way. Yeah, I suspect that an Earth-based fusion reactor would happen first. Uh, Note, we haven't, other than in the lab, been able to generate an energy surplus from fusion technology. Right now, it takes more energy than it generates, which is not helpful.
Yeah.
But
Let,
who
let me
knows
ask you
what
this
happens going
on
forward?
fusion, just to ask you to speculate. Do you think we will commercially succeed in fusion in your or my lifetime?
People who know more than I have said yes. I don't know. People who know more than I, Chinese people who know more than me at China General Nuclear, have suggested that uh, we will have commercial scale thorium reactors in my lifetime. We've been working on thorium for 40 years. It's pretty good for getting research grants and selling newsletters.
Hmm.
It hasn't generated much power,
Yeah.
but my friends at CGN tell me that the Chinese will have a commercial thorium reactor up in a decade.
Okay, but that's not fusion, right? That's still
No,
fission.
different
Yeah.
technology,
Yeah.
but
Yeah.
there's two proximal. There's two potential technologies in the future that, if they came to pass, would dramatically lower uh, our societal electrical costs.
Yeah. Well, let's cross our fingers and hope that actually does happen. All right, so we're getting a little tight on time, but I do want to squeeze this in. So, as I mentioned in the intro, we've had breakouts going on in the precious metal sector. Um, if you can, well, just give us your thoughts on that. And as we talk about this, let's try to wrap in just how much of that is due to demand versus how much of that is due to people getting really, worried about the decline of purchasing power of fiat currencies.
The 25-year gradual escalation of the gold price. When people ask me when the gold price is going to rise, Adam, I say, well, I think year 2000. It was 253 bucks an ounce. People were still asking me when the gold price was going to go up when it was at 2000 bucks. I said, you've had an eightfold move, right? So anyway, that trend in motion, I think, has generated a fair bit of attention now. I think it's fair to say we're in a precious metals bull market. And bull markets follow a very predictable path. The commodity moves first. We saw that in gold. Uh, People are frustrated because the commodity moves, but the equities don't move. We saw that. You may not recall, but I talked about that on your show. Some of your listeners were frustrated about the fact that the gold price had moved, but the gold equities hadn't
Hmm.
moved. That's understandable because gold had a buyer, the central banks, and they don't buy gold stocks. So an asset class that had buyers went up, an asset class that didn't.
Right.
The momentum that was established by the gold price began to give equity investors courage at the same time that the increase in the gold price gave producers better margins. And so now we've seen the best of the best gold producers really start to rip. I mean, the last 18 months have been, from the point of view of the Wheaton Precious and the Agnico Eagles, by the way, both exhibitors at my conference.
Okay. And
When
stocks that you have directly recommended to this audience in previous years. So,
when these great big guys go crazy,
yeah.
that attracts attention. And just in the last 15 weeks, you've begun to see retail inflows into the gold equity ETFs. These things follow very predictable paths. I think they follow predictable path for real reasons. I believe in the United States and around the world that our social debts and deficits exceed our ability to service them in very
Mhm.
simple senses. I'll give you America's math. Our on balance sheet liabilities exceed $36 trillion. And despite the Department of Government Efficiency, the new Trump budget projects the fourth largest deficit in history. The spending increases take place now. The spending cuts take place, if they ever do, 4 or 5 years from now.
Mhm.
But that isn't the biggest problem. The biggest problem is the off balance sheet liabilities. The net present value of unfunded entitlements in the United States, according to the Congressional Budget Office, exceeds $100 trillion. So, Adam, let's add those two numbers, 100 trillion and 36 trillion. That means, as a society at the federal level, before state and local debts, we're 130 trillion net upside down. To put that in perspective, the Internal Revenue Service says the private net worth of American citizens is 141 trillion. So there's $11 trillion margin between what we owe and what we have as private people. But it gets worse. The on balance sheet liabilities of the US government, represented by the deficit, increase at $2 trillion a year. The net present value of unfunded liabilities increases between $2 and $3 trillion a year. The political solution, tax the billionaires. Let's look at the arithmetic there. The private net worth of America's billionaires is $6.7 trillion, according to the IRS, and they ought to know. They got their eyes on it. If you stole all the billionaires' money, not just increased their taxes, but stole all their money, ate your seed corn, you would solve the problem for about 18 months. So what do we do?
Right.
Do we
And you would destroy the biggest drivers behind,
correct?
the driving commerce. So your
That's,
ability to, your GDP growth would tank.
that's why I said you're eating your seed corn.
Yeah.
But that doesn't seem to matter to the political class. So what are the alternatives? Well, you could have an honest default. You could say to the bondholders, too bad, so sad. We quit, strong letter to follow. Or you could do what we did in the decade of the 70s. You could devalue the obligation by allowing the purchasing power of the US dollar to decline. And I think that's what's going to happen. In the decade of the 70s, the purchasing power of the US dollar fell by 75%. Not coincidentally, the gold price went up 30-fold. I'm not suggesting the gold price goes up 30-fold from here, but it wouldn't surprise me to see an increase in the gold price that's commensurate with the deterioration of the purchasing power of the US dollar.
Hmm.
And I note you're going to go to silver. Uh, Silver's a late market mover. The momentum has to be established by precious metals, when by gold. When the momentum is established by gold and later by gold stocks, and the generalist investor comes into the precious metal space, it's happened the last three bull markets. Leadership goes from gold to silver. Not leadership like you've seen in the last 2 weeks, $2 leadership. When the silver market catches on fire, you're not going to need Rick Rule to tell you. People were asking me last week, what do you think about this $2 move in silver? And I just said, I don't think about it at all. I own silver because of quantum moves, and I think that quantum moves are not certain, but more likely than not.
So let me just ask you on that, Rick. So I agree with you that I think silver's potential price movement here is much larger than we've seen so far. But it was really had a lot of trouble getting above $35 an ounce.
Yep.
The fact that it did, that's a necessary milestone to higher price or faster price movement at some point in the future. How material is that breakout from 35? I mean, I know you think it's going to go a lot further, but are you like, hey, that tells me where we are in the story, that this is really about to move, or are you just like, nah, it's not a big deal?
It may be a big deal. I'm just not smart enough to tell you. You're talking about the impact of a narrative on popular culture. I don't own a TV, and I don't know how to dress myself. So I'm the wrong guy to comment on that. But I have lived through three prior precious metals bull markets. I got a pretty good read on history. So I don't know if that's psychologically important because that's not how I operate. What I do know is that the arithmetic behind our economy suggests materially higher gold and silver prices. And my experience tells me that when leadership goes from gold to silver, silver moves further and it moves faster. I can't
Faster.
tell you when.
Yeah. So we've talked about this, Rick. I like this analogy, and I think you do too. I think I've talked about it, but I think of the precious metals complex as a whip. Gold is the handle. It
Yep,
moves first.
yep,
On an absolute basis, it moves the least,
yep.
but it
That's
moves
right.
first, and then the middle of the whip follows. That's the mining complex, and you can probably break it in half. The bottom part of the middle is the majors, and the
Yep.
top part is the juniors, and so they're going to go further, faster. And then silver is the tip of the whip, right? Moves last, moves the fastest and the farthest. Decent
No,
analogy?
I think that's absolutely right. I think at the same time that silver moves, the sort of gold exploration companies, the people looking for gold as opposed to having gold, the penny
Yeah.
dreadfuls, really, really, really rip. Well, whether or not that's suitable for your audience is a very different question.
Well, I will encourage them to go to the symposium and then get educated and make up their mind about what's relevant and safe for them or fitting for them. Let me ask you this though, and I'm asking you to guesstimate here, and no one's going to hold you to this. If we are in a new bull market for the precious metals complex, if we break it into its three components, gold, mining stocks, silver, where would you put each one in terms of the inning of the bull market, would you think?
I would suggest that we're between a quarter and a third of the way through the bull market. We're just seeing leadership transition from gold to metal to the best of the best gold equities. Now you'll begin to see the best of the best equities enjoy a lower cost of capital, higher share prices than the rest. And you will either see value arbitrage in the market where people go to the undiscovered parts of the market, or you'll see the big companies take over the little companies. That
Right.
happens in capital intensive businesses. Uh, we've enjoyed a nice move in the gold price. And I'm not sure that the gold price moves up in real terms from here, but it certainly moves up in nominal terms.
Nominal. Hmm.
That's what happened in the decade of the 70s. The first part of the decade of the 70s, the move from $30 to $100 can be explained away simply because it was the private ownership of gold was illegal. And you took the price control off and you tripled the price. I would suggest that the move from 100 to 500, 600 was a response to the deterioration of the purchasing power of the US dollar. And the move from 600 to 850 was simply investors piling on. A trend in motion continues until the morons get massacred. Uh, so I suspect that there's a three or four-fold move in the value, nominal value of the whole complex over 10 years.
Okay. Um, all right. And I guess just since you said 10 years, when you talk about a new bull market in the precious metals, are you thinking it could have legs for the next decade like that?
I do. I do. I don't understand how you resolve the world's political problem. We're going to get out of this just like we got out of the decade of the 70s. But there's going to be a reckoning. And when I say the U.S. dollar is the purchasing power is going to depreciate, I mean in absolute terms. I think other currencies will do as bad or worse.
Right.
I'm
Exactly.
not
Yeah.
suggesting that the U.S. dollar will fall by 75% against the yen or the yuan or the Canadian dollar. I think most of them will do worse than the U.S. dollar. I just think, in an absolute sense, uh, that 2035 dollars will buy you what 250 $2025 will buy you.
Right. Right. This is the bonfire of the fiat
Yep.
currencies, not just any one in particular one.
Yep.
All right. Well, look, Rick, problem with you is I could go forever, and we live in a world of finite resources, time being one of them.
True
Um,
enough.
so, so I got to start wrapping it up here. Thank you. And again, folks, I want to remind you the URL to learn more about Rick's symposium is thoughtfulmoney.com/rule symposium. Again, I'll have the link right below this video as well. Um, Rick, any last words about the symposium that maybe we didn't mention when we talked about it earlier that you want folks to know?
Yeah, I think we've said it all. Time is on our side in natural resources, and time is really on our side, maybe in the near term in precious metals. Uh,
Okay.
this
Sorry to interrupt,
is
but when I have you on our conferences, when you come on the Thoughtful Money conferences, you do an incredibly generous job of banging through a whole bunch of actual tickers of the companies that are on your watch list. I just want to let folks know, today I'm pulling Rick's brain on the higher level stuff. If you want to get those specific type of, hey, what companies should I be looking closely at? They're going to get that in spades at the symposium, right?
absolutely, absolutely, not just from me, from lots of veterans. And there's going to be a bunch of exhibitors, including Wheaton Precious and Agnico Eagle, not just the little guys. Everybody's going to be there. And the value is exemplified because, unlike any other investment conference on the planet, we offer a no excuses money back guarantee.
That's just ridiculously
It's
generous. And I mean,
financially ruthless.
nobody's going to ask for that because they're going to be walking away from there with a
Right.
head they can hardly hold up given how much information is crammed into it. All right. Well, look, Rick, can't wait to see you there. And it's just a couple of weeks. So look forward to seeing you in Florida. Folks, please come join us again, thoughtfulmoney.com/rule symposium. If you enjoyed this conversation with Rick, please let him know that by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. If you have questions about how to integrate commodity and commodity stocks into your portfolio, highly recommend you get that, well, by going to Rick's Symposium and talking to the experts there. But whether you do or you don't, most people watching this, when it comes to their own portfolio, should talk to a good professional financial advisor who can help counsel them. Okay, what percentage of your portfolio should we put in this? Do we want to hedge any parts of it? All that type of stuff. If you've got a good advisor who's doing that for you, great, stick with them. If you don't, then consider talking to one of the financial advisors that Thoughtful Money endorses. These are the firms you see with me on this channel week in and week out. To do that, just fill out the short form at thoughtfulmoney.com. Only takes you a couple seconds. As a reminder, these consultations are totally free. There's no commitment to work with these guys. It's just a service they offer to be as helpful as possible to as many people as possible. Rick, I will let you have the last word, my friend. What parting bits of advice would you have for today's viewers?
Remember, you're either a contrarian or you're going to be a victim in resources. The complex is underowned. It will go over 10 years from underowned to overowned. If you're going to do it, start learning it. Start learning it now. Adam, thank you for this visit. I look forward to hosting you and as many of your listeners as we can handle in Boca Raton or in the comfort and convenience of their own home via live stream.
Can't wait to see you there, Rick. Thanks so much. And everybody else, thanks so much for watching.